Hello, everyone. My name is Mark Blythe, and I am the director of the Rhodes Institute for International Economics and Finance at the Watson Institute for International and Public Affairs at Brown University. I think that's a 200-point Scrabble score if you lay it all out in one line. Anyway, we're here today to talk about early American money. If you have been here in person, if we lived in a world, a counterfactual world in which COVID doesn't exist, many of us would have been here in person. We would have had a nice dinner the night before. We would have met each other and chatted. And unfortunately, we can no longer do that. But what we can do is adapt to the times. And with this new format of basically breaking panels out and doing them singularly over multiple iterations, I think we've happened upon something which going forward we can really use and integrate into the type of work that we do and the type of workshops that we do. A couple of comments by way of opening. Very excited to have this conference happening under the auspices of Rhodes. Excuse me. In part because Rhodes is dedicated to a genuinely interdisciplinary understanding of economics, finance, money in all of its particular and general guises. So this one squarely fits the bill. I personally, unfortunately, have to duck out after an hour because my department annoyingly schedules PhD practice talks at 12 o'clock. So I have to depart, which is a shame because I really want to hear the whole conversation. Just by way of setup, I think that this is incredibly relevant in the current moment because we grew up, or at least I grew up, in a period in which the depoliticization of money was very much the norm. The rise of independent central banks, technocratic governance of monetary affairs, and that politicization is back. The type of arguments which animated the early American money debates are very much redolent in terms of credit provision, the arguments of modern monetary theorists, the fact of central banks emerging as de facto fiscal agents in all over the world. These are the types of concerns that were raised then, and they're back now because they in fact never go away. So this is a very good time to revisit those, to remind ourselves that we have been here before, and it is a hardy perennial. And with that, I will pass on to my colleague, Seth Rockman, to kick us off. Thank you, Seth.
Thanks, Mark, as well as to Hayden Reese at the Rhodes Center for doing much of the administrative work that's making today possible. So yes, as many of you know, we were supposed to convene in Providence last March, just as the university was suspending operations in light of COVID. So we're truly grateful for the chance to reconvene today, and of course, to be able to take advantage of our new Zoom adeptness to welcome participants from far-flung locations to today's conversation. I'll speak for a moment about some of the intellectual rationales of this gathering, and then I'll introduce the co-organizer of this conference, Ann Daly. Ann, in turn, will speak further about the goals of the workshop and introduce today's three presenters. So, the history of money. This is an emerging scholarly conversation predicated on, historians being historians, the idea that modern monetary regimes do indeed have a recoverable history, one that's different from the more mythological origins story that describes money as something that emerged in the fog of a primordial past to overcome the inconveniences of barter. Money in that well-known origin story is a self-organized entity, and when it stops meeting the needs of market actors, they innovate new forms of money to better serve the needs of exchange. In that story, markets summon money into being, and it doesn't really matter what that money actually is, so long as it can function as a medium of exchange, a unit of account, and a store of value. For historians, though, this is unsatisfactory, especially since the preponderance of evidence they have for the past 500 years says that there is no story of money without the state at the center, whether directly as the creator of the medium of exchange and the rule setter about what can and cannot be used to pay taxes and settle private debts, and indirectly as the generator of the resources on which money is comprised, land or precious metal, for example, usually through the state's military power. In this historicized version, money as a creation of the state is what summons markets into being, since market actors won't appear unless they have some reasonable expectations of the future value of money, since there's no need to accept it in exchange for some commodity or to loan it out in anticipation of future repayment, unless you have faith in the legal regime that backs it and that enforces contract through judicial processes. From this fundamental premise, historians now talk about money as something that is engineered, something that is designed through the mechanisms of state power, and something intimately tied to sovereignty, The history of money then is fundamentally a political history. And this is true on several levels. One, in the sense that it's recovered through a focus on elections, on policy makings, and on the legal system. That is the state's ability to declare some money as suitable for paying taxes or mandating its acceptance as legal tender for settling private contracts. But money's history is political in a second and more expansive sense of the word too, relating to the exercise of power in the realm of society and culture. Money, in its tangible form and as an abstract concept, functions to constitute and reflect forms of identity, as well as to construct and contest structural categories of difference like race or class or gender. Struggles to control money's availability through law and to control money's meanings through culture combine to reveal the broader contours of power in the past. And thus it is fundamentally political. These are some of the broader premises that have informed a new history of money that's emerged in numerous places across the academy and has brought together scholars who find their homes in law schools or in economics departments, as well as in political science and history departments. To that extent, it is an opportunity that we have today to promote an interdisciplinary conversation and think about the way in which this new history of money looks, narrated through different disciplinary perspectives. So I'm very, very excited about the conversation that we'll have today. But of course, this is not about the entire history of money today. This is about a particular history of money that is tied to the new United States. And in a few minutes, my co-organizer, Ann Daly, will talk a little bit more then about why the new United States provides a particularly robust space for thinking through money as a political problem and as an example of the way in which the state truly matters to our understanding of the economic past. So Ann Daly is a PhD candidate in the Department of History here at Brown, and her dissertation, Minting America, Money, Value, and the Federal State, 1784 to 1858, will be completed this year. Daly has presented her work at the annual meetings of the Business History Conference, the Society for the History of Technology, the Organization of American Historians, and the Society for Historians of the Early American Republic. And one piece of her study, entitled Every Dollar Brought from the Earth, Money, Slavery, and Southern Gold Mining, 1828 to 1858, has been accepted for publication at the Journal of the Early Republic. Daly has held fellowships at the American Philosophical Society, at the Smithsonian, the American Antiquarian Society, the New York Public Library, the Mass Historical Society, and next year she'll be the postdoctoral fellow in the program in Early American Economy and Society at the Library Company of Philadelphia. Daly organized this conference as the graduate fellow of the Rhodes Center. And on a personal note, it's simply a pleasure to say that Ann Daly is the person who is responsible for bringing me into this conversation. A few years ago, as I was minding my business as a sort of, interested observer in the history of capitalism, Ann put together a proposal for a dissertation and then said, you're going to have to figure out a lot about the history of money if you're planning on advising this. And as a result, I put together, with Ann's help, an undergraduate seminar that I've now taught for several years on the history of money. And it has brought me into a conversation that I find utterly fascinating. And it's harder to think of a better sort of testament to sort of where one's life as an advisor meets the intellectual world of an advisee when they bring you into a new conversation. So I'm truly grateful to Ann and very pleased to be able to acknowledge that publicly today. And with that, I turn it over to Ann to take us into the conversation that we'll have. Thank you.
So thank you, Seth, for that really kind introduction. And I'd also like to echo that I'm really glad that you can all join us here today on Zoom and that we can all adjust in this brave new world of online conferences and roundtables. So I'm just going to start with a brief discussion of some of the inspiration behind this roundtable and the literature that's influenced it. And the basic idea behind this panel is to bring together two slightly different schools of scholarship. So the first is the new history of money, which Seth has just done, I think, an excellent job of explaining and has a great deal to offer to our understanding of American history. And then the second is the history of the early United States. And the basic contention of this roundtable is that this particular period in time also has much to offer to our understanding of the history of money. So briefly, the roundtable really had its origins in the recognition that these emerging conversations around the history of money had the potential to reorganize our understandings of American sovereignty and governance and politics between the Revolution and the Civil War. Now, I think Seth has just given a great overview of the new history of money, but I want to point out a couple particular things that I think are especially relevant to this project. And that's that the new history of money really sees money as a legal institution, and one that's created by governments and can be deployed to create a more democratic and egalitarian society. And this really echoes what we see with the history of money in the early United States. So for those of you who may not be familiar with the monetary regimes of the early Republic US, let me just start by saying that the US has a very distinctive monetary history. And in my admittedly biased opinion, no nation has taken a more experimental approach to currency and monetary regimes. So just to give you a few examples, the colonies created some of the earliest state-issued fiat currency. But in the early republic, after independence, Americans navigated a world in which paper notes of widely varying value issued by thousands of banks were in circulation, forcing them to navigate a morass of currencies of extremely variable quality. And this monetary diversity led Americans to experiment with their monetary institutions. So for example, to the best of my knowledge, the early US is one of the only places that's established and then destroyed their national bank on 2 separate occasions. And for much of the antebellum era, we see that money really becomes the central animating political issue. It organized entire political parties over questions about what kind of money the nation ought to use, how it worked, and who it should benefit. And then finally, the nation's system of dispersed administrative authority multiplied the venues, state and federal, public and private, for making and unmaking monetary regimes. So this idea is that the US's distinctive and experimental and even radical monetary system, or really systems, offers a kind of laboratory in which scholars of money can test their theories and uncover new understandings of what money is and how it works. And at the same time, since money was so crucial to the development of antebellum politics and to American capitalism, it's an important consideration for historians of the early US. And there's much that we can learn about this period by borrowing from the new history of money and learning to take money not just as a thing in existence, but as a category of analysis. So we recognize that there are multiple avenues to get into these larger questions. And so today we've assembled 3 panelists who are coming at early American money from these different perspectives, whose work has helped to untangle the truly Byzantine world of antebellum currency, and who I think can guide us in exploring the relationships between money, the state, and society in early America. So before I introduce the speakers, I do want to go over a few logistical considerations. Each of our speakers is going to give about 10 to 15 minutes of prepared remarks, and after that, we're going to be opening the floor to questions from the audience. And if you have any questions for either individual panelists or for the panel as a whole, you can post them in the Q&A function at the bottom of your screen. And then finally, this event is being recorded and it will be available through the Watson after it has concluded. So if there's anything that particularly interests you and you want to go back and watch it again, feel free. All right, so now I'm going to introduce our panelists in order of their remarks. So our first panelist is Jeffrey Sklansky. He's a professor of history at the University of Illinois at Chicago. He specializes in the intellectual and social history of capitalism in 18th and 19th century America. He's the author of several books and articles on money in the early US, including most recently, Sovereign of the Market, The Money Question in Early America. This is a history of the money question in early American history, and it explores debates over what should serve as money, who should control its creation and circulation, and what principles should govern it. It received the honorable mention for the best book in US intellectual history by the Society for US Intellectual History. And our second panelist is Jane Knodell. She's a professor of economics at the University of Vermont, specializing in economic history and money, banking, and the evolution of monetary institutions. She's also the author of many books and articles on 19th century American money, including her recent monograph, The Second Bank of the United States, Central Banker in the Era of Nation Building. Now, this book reassesses the Second Bank of the United States' role and legacy, and it fills an enormous gap in our understanding of the operations of the antebellum US's national bank. She's also currently at work on a joint project with Catalina Vizcarra also at the University of Vermont, titled Managing Silver Money on the Periphery of Empire, Views from North and South America. And then finally, we will be joined in a few minutes by Christine Desan, our final panelist. Christine Desan is the Leo Gottlieb Professor of Law at Harvard Law School, and she specializes in the constitutional law of money. She's the author of Making Money, Coin, Currency, and the Coming of Capitalism, which is a history of the origins of our modern monetary system and the development of capitalism, as well as the role that law and government have played in creating money. She's also the co-founder of Harvard's program on the study of capitalism and the founder and managing editor of justmoney.org, a website that features debates and interdisciplinary scholarship discussing money's designs, origins as a legal project, and potential use as a tool for creating a more just political economy. And I'm sure this site will be of interest to anyone watching this roundtable. All right, so without further ado, let's hear from our first panelist. Jeff?
Thanks, Anne. I want to thank Seth and Anne for organizing this really terrific and exciting conference and bringing us together even under extraordinary circumstances of the COVID crisis, among other things. The conference is a very exciting testament, I think, to the flourishing subfield of the history of money. And I'm really looking forward to learning from the work of so many wonderful scholars. I'm especially delighted and really honored to participate in this roundtable along with Chris and Jane. A warning that there's some deafening plumbing-related noise coming from just on the other side of the wall, and also my connection is cutting out intermittently, so I missed Seth's opening remarks, unfortunately. So, sorry about that. So please bear with me. I want to highlight a few central insights and questions that are underlying recent scholarship that I think are revealed with unique vividness and force in the history of the early American Republic. And I'm going to group these under two headings. One is payments and power, and the other is bank and state. So payments and power. The ideology of contractual freedom accustoms us to think of payment as a reciprocal transaction between formal equals or petty proprietors exchanging their respective products and services through the medium of the market. This is a view that's implied in the conventional economic conception of money as a solution to the problem of the so-called double coincidence of wants, basically an outgrowth of barter, which Seth did mention, as I've heard, enabling market transactions among supposed strangers over long periods and long distances. But recent scholarship reveals money as I think many early Americans understood and experienced it most directly, which was as a mode of exercising authority and subordination, an instrument of governance and class rule. It's fundamental relations of power that became monetized in the new nation. Or another way of putting it would be to say that social obligations became debts. The imposition of ruling class commands in the form of monetary debts is, of course, an age-old story, as the anthropologist David Graeber shows in his sweeping study, Debt, the First 5,000 Years. A debt is the obligation to pay a certain sum of money, Graeber explains. As a result, a debt, unlike any other form of obligation, can be precisely quantified, and this allows debts to become simple, cold, and impersonal, which in turn allows them to be transferable, unquote. And the transferability of such obligations, enabling assignable and negotiable IOUs, unlike, say, traditional book debts or oral promises, to circulate as currency, became a main pillar of the structure of power in the early United States, as Bruce Mann writes in his legal history, Republic of Debtors. Indeed, the monetization of mastery over persons and things took distinctive form in the early Republic, as wide-ranging financial histories by scholars such as Jonathan Levy, Eli Cook, and Caitlin Rosenthal have richly illustrated in recent years. In part, the proliferation of exchangeable paper promises to pay reflected the scarcity of capital with which to fund the prodigious expansion of the United States as a developing country, as historians like Edward Molaison and Robert Wright have emphasized. But more basically, the conversion of enforceable obligations into transferable debts took distinctive shape amid the pervasive commodification of land, labor, and necessities like food, fuel, and housing in the early Republic. many of the new relations of expropriation and exploitation that early American capitalism comprised were expressed as monetary obligations, including relations between native peoples and settlers or speculators, between employers and employees, between planters and slave traders, between landlords and urban tenants or mortgage holders and family farmers, and between shopkeepers and struggling households. In the new United States, in many ways, power came to reside in two closely linked capacities: the ability to impose or dispose of monetary obligations, and the authority to determine the means of discharging those debts. To a growing extent, the dual problem of class power that Eugene Genovese and Elizabeth Fox Genovese once memorably posed to social historians, who rides whom and how, came down to the twofold question of who pays whom and how. The second part of that question, how early Americans paid for land, labor, food, and shelter, not to mention how they paid their taxes, which I'll get to in a couple of minutes, is of course our central subject as historians of money. But the means of payment formed a pressing question for early Americans themselves for two reasons. On the one hand, the means of payment became a scarce commodity as more and more people became increasingly dependent on access to cash and interest-bearing credit for their livelihood. What the political economist Ellen Meiksins Wood calls generalized market dependence meant increasingly universal dependence on the monetary means of market transactions. And though we sometimes speak of the rising need for money in the early republic as a function of popular demand, we should keep in mind that the demand for money was largely imposed by those who controlled its supply, as backwoods debtors who took up arms against coastal creditors and urban workers who rioted against bankers and merchants knew well. On the other hand, the supply of money was itself a complex and contested question in the early republic. It wasn't merely the question of the quantity of money relative to the volume of transactions, a question familiar to economists, but a question about the qualities of money, or rather of multiple monies. For, as Anne has alluded to, the means of payment on which early Americans increasingly relied were dizzyingly heterogeneous, comprising thousands of varieties of currency issued by many competing sources on radically different and sometimes opposing terms. Early Americans contended not only with how much money they needed, but with what kind, not only with who paid whom and how, but with who made the means of payment and how. Protracted constitutional struggles over the means of payment went hand in hand with conflicts over the commodities for which they paid. Monetary instruments and institutions figured for early Americans not simply as technological or organizational innovations in the interest of increasing efficiency or solutions to the economic problems of so-called information asymmetry, like adverse selection and moral hazard. Like concurrent developments in business organization, accounting, and management, new kinds of currency were both products of emerging class relations and constitutive of those relations themselves. To cite one example familiar to labor historians, the nascent workingmen's movement of the 1820s and 30s linked the struggle against the exploitation of wage labor to protest against the currency, the so-called uncurrent notes in which wages were mainly paid, and against the flood of banknotes that fueled the skyrocketing cost of housing, food, and fuel in the seaboard cities. Currency reform remains central to the cause of organized labor throughout the 19th century, and we've yet to come to terms with the enduring ways in which the organization of currency and credit enabled bankers and bondholders to command the labor of a far-flung workforce for the first time. So too, 19th century conflicts over the transfer of Indian territory to the US government and then to settlers, speculators, and corporations came to center on the forms of payment of annuities to native nations and on the creation and circulation of various kinds of scrip, entitling recipients to Indian lands, what we might call the currency of conquest. Claudia Sant's new history of Indian removal highlights the commanding role of finance in orchestrating mass dispossession and deportation, illuminating the relationship between the money question and Western expansion in the Jacksonian era. But perhaps the clearest example of how conflicts over new monetary obligations were tied to struggles over the means of paying them came in the Revolutionary and founding eras. As Andrew Edwards has incisively shown, Colonial resistance to the Sugar and Stamp Acts of the 1760s focused on the scarce silver, in which taxes had to be paid, coupled with a concomitant British ban on the creation of colonial paper currency. Ironically, the paper IOUs with which the Continental Congress paid soldiers and suppliers during the Revolution gave rise to a similar currency conflict in the new nation. As Stephen Stoll has recounted in his stunning recent history of Appalachia, wealthy speculators who bought up the depreciating Continentals from cash-poor veterans at steep discounts were rewarded with new notes redeemable for their full face value in gold and silver specie, paid for with steep new taxes on the whiskey that impoverished Western farmers used as a locally controlled currency, which incited insurrection once again. As Bray Hammond dryly notes in his landmark 1957 synthesis, Banks and Politics in America, if the state wanted taxes paid, it had some responsibility for providing a medium in which they could be paid. Indeed, as cartelist theorists have long maintained, and as Seth described, I think, money does not originate in the market, but in the state. Taxes are, in a sense, the original monetized obligation, intrinsically tied to the sovereign's authority to issue the legal tender with which to pay them. And in the financial revolution of the 1780s and 90s, the state and federal governments delegated this sovereign prerogative to commercial banks, much as the English government had done in its own financial revolution a century earlier, as Chris Desan has brilliantly argued. This is the second central theme of recent work on the history of money in the early republic that I want to mention today, and that's the union of bank and state. Commercial banks, which scarcely existed in colonial America, proliferated in the new nation, and the banknotes that they lent out became the principal circulating medium between the founding and the Civil War, when the federal government replaced them with a national paper currency. Thus, the money question and the banking question converged in the early United States. That is, the question of what would serve as money came to focus on banks, and the question of banks' special privileges came to focus on their note issue, on their control of the currency. From Bray Hammond to Sharon Ann Murphy's elegantly compact and comprehensive recent survey, Other People's Money, histories of early American banking highlight its dual public and private character. On the one hand, banks in America were born not as repositories for wealthy families' fortunes, as in Europe, but as corporate creatures of the state, entrusted with quasi-sovereign control over the money supply. And though banks gradually cast off many of their public responsibilities, as Hammond notes, they, quote, never lost all birthmarks of their public origin. On the other hand, as Naomi Lamoureux has written, American banks began mainly as channels of funds to their own directors and their families and associates, rather than serving ordinary households and other customers seeking credit. And even as the notes that they issued came to circulate widely through the expanding market economy, they never relinquished their primary pursuit of capital accumulation on behalf of investors and directors. The spiraling conflict between banks' public mission and private profit focused on two aspects of the ascendant banking industry, charters and notes. And in that way, the politics of banking and its focus on charters and notes both revealed and concealed essential features of the commodification of the means of payment. So I'll just briefly say a word about each of them. American banks' reliance on corporate charters from state legislatures, unlike in England, spotlighted their status as quasi-public entities, encapsulated in the term state banks, symbolized by their imposing neoclassical architecture. Popular suspicion of banks' betrayal of the public trust fueled a host of efforts to strip banks of their public privileges and functions, to ban or restrict the issue of bank charters, to create partially or wholly publicly owned banks, or to open up banking to all qualified groups of investors instead of limiting it to those with special charters from the state. That's the model of so-called free banking that spread from New York in the late 1830s to prevail in many states and ultimately across the country by the 1860s. And free banking seems to me an especially promising topic for further scholarship. Yet the political preoccupation with the question of charters in some ways obscured the ways in which banks would continue to exercise extraordinary sovereign authority over the means and mechanisms of payment long after the original umbilical cord between bank and state had been severed. Opponents of banks' control of currency generally focused on their distinctive power of note issue, demanding either that the banks cease issuing notes entirely or banning small denomination notes, really the only banknotes that circulated widely among ordinary people. But here again, the preoccupation with the physical means of payment obscured in some ways the ways in which banks would continue to control the main money supply, even without note issue, particularly by making loans in the form of demand deposits. I'll just mention, in addition to bank charters and notes, one additional aspect of banking in early America that points to the marriage of bank and state, and that's banks' role as merchants of government bonds, as managers of public debt. The financial revolution in the early republic inaugurated a portentous partnership between local, state, and national governments on the one hand, and an ascendant capitalist class of public creditors, one very much still with us today. In experiments with publicly owned and operated banks, the capital that secured the bank's notes still came from the sale of government bonds to investors in the capital-rich Northeast and abroad, which went to support many state governments in the South and West. Under free banking, banks were likewise required to hold government bonds as capital reserves, creating a booming market for public debt. The first savings banks invested the small deposits of working class households almost exclusively in local, state, and federal bonds. And investment banking, the nascent investment banking industry likewise emerged primarily to market government bonds to fund internal improvements and war expenditures. And in all of those ways, early American banking institutionalized government's dependence on wealthy bondholders, borrowing the money that banks now controlled, then taxing citizens to pay back the mounting interest on the public debt. And that long-lasting relationship between bondholders and taxpayers seems to me to deserve further consideration as well. But I'll stop there with thanks again for inviting me to participate.
Jane, if you'd like to go ahead.
All right, very good. I also want to thank Seth and Anne for organizing this great symposium and including me, and I really have appreciated many of Jeff's comments, and Anne's and some of my remarks will reinforce some of the points that have already been made here. I regarded my remarks as kind of being asked to kind of set the table for this symposium with new research on money in early America in the period from the Revolution to the Civil War. So from my point of view as a monetary historian and someone who loves to teach money and banking more than probably any other class, you know, in the history of economics, I'm coming at it as someone who's very interested in how money works and how monetary institutions are formed, what determines how they evolve, and also how they perform. And I have summarized in these slides kind of how economic historians have approached this period, and some ways in which we can go deeper in our understanding of American money. And I think that in their remarks, Seth and Jeff have all kind of laid this, offered some answers to this last question. So this was a period of commercialization of agriculture and a shift out of agriculture and into manufacturing and services, and thereby a period of growing monetization, which for economists just takes the form of a rise in the quantity of the money stock per person in your economy. But underlying that measure is the fact that a growing share of the population was becoming wholly dependent on the market to meet their needs. And the reliability of money becomes a more and more important issue the more there are people who are wholly dependent on the market. If you are dependent on the market and a free person in the antebellum US, in the sense of someone who was not enslaved, your ability to meet your material needs depends in some fundamental way on whether the money you use is good at conserving value over time. Will you be able to spend this money at full face value at some point in the future? This money that you received in payment for what you produced. And that includes obviously wage labor, where you are supplying, as Marx would say, your labor services. So what were the components of the antebellum money supply? I always think of it in kind of two broad segments. First, there is the specie, the silver and gold coin, commodity money that is supplied through the coining of precious metals, either at US government operated mints, which, or imported from other countries, notably Mexico. So during much of this period that we're studying, much of the specie stock actually came from Latin American mints. And the US was relatively slow in so-called getting its act together in terms of minting its own coin. And I think we're gonna, Ann Daly is doing some excellent work on this and very under-researched aspect of US monetary history. But the specie was the best money, the safest money, the most liquid kind of money. It's the analog of the money that the Federal Reserve creates today. I think the post-Keynesian monetary economists have something very important to offer to the conversation that we are having here, which is to always point out that there's always a hierarchy of money. Whatever period of history you're looking at, there's a money that's at the top of the pyramid that is regarded as the best money in the system. And obviously in bank panics and in financial panics, which are obviously still with us today, there's always a rush to that best kind of money. So that was obviously true in this period as well. And then there was the credit money, what post-Keynesian economists would call credit money, which were the bank notes and the bank deposits that were supplied through an act of lending by a bank. And they were to be paid on demand in specie. And so that, was that something that helped support the demand for these banknotes? But contemporaries at the time asked, was this credit money, was this real money? Or really, was it a fraud upon the public? What is this stuff? It's just paper. So as Anne pointed out, the quality of money in antebellum America was not uniform. So in that sense, very much unlike today, when federal deposit insurance makes our money, which is, we're all individuals, small businesses and so forth, bank deposits is our money. And our money is of uniform quality throughout the United States because of federal deposit insurance. So the deposit insurance means there's no risk of loss to insured depositors. So all money is equally good, all of these deposits. But in the antebellum period, this was not true. Even within the stock of specie, there were differences in the quality of money. The money that circulated at the retail level and among wage earners, the commodity money, were very worn pieces of eight, pesos that had been cut up into eighths and kind of worn away through intensive use, versus the heavy, that is, high silver content, well preserved, intact pieces of eight were the best kind of money. And that was money that had a lot of value. And so there was variation even within the stock of specie. Bank money versus the specie. Some bank notes were better than others in the sense that they circulated more widely and they maintained their value. They were at first full face value wherever they were and over time. There were some state governments that created insurance funds during the antebellum period, but that was very spotty. But I think it's an interesting area for research that economists have studied a bit. So some currency holders were protected by these insurance funds, but overwhelmingly majority were not. So of course, this uneven quality of money had a very uneven impact in the sense that, as today, some people are better informed about monetary affairs, and they're better positioned to protect their wealth against bad money. Banking was a highly political issue, in part because of this increasing dependence on the market and increasing awareness of the fragility of your position as a wage labor, as a small farmer operating on the margin of viability, of being able to sustain yourself. There were periodic bank crises that imposed losses on banknote holders and depositors and shareholders, but we tend to be less concerned about the shareholders because presumably they got the return and they also needed to bear the risk. So these losses, in addition to other factors, thrust money into the political domain. Governors and state legislators were asked, what are they going to do about this? There were banking riots after bank failures in the 1830s and 1840s. Baltimore and Cincinnati are two, they're very well known. There may have been many others that have not yet made it into our literature. Banks, another reason that banking was political is that they were incorporated, and as such, they were regarded as having the privileges of incorporation. They had the privilege of issuing money, the notes and deposits, bestowed upon them by the state. And they enjoyed some measure of limited liability, the owners did. In some sense, they represented capitalism and the power of capital over labor, and banking policy became a major issue defining the Whig Party and the Democratic Party. Okay, banking was decentralized. So under the Constitution, the state governments lost the ability to issue fiat money as their predecessor colonial governments had. But they did gain the ability to charter banks, and they chartered a lot of banks. There's an interesting debate that is in the Financial History Review that includes Dick Silla and Farley Grubb about the Constitution and this point about state governments losing the ability to issue fiat money was obviously a real turning point in the history of American money. And I think that it's interesting to think about, how did that period of colonial government issuance of fiat money, meaning money that was paper money, it was just money by fiat, how did that form possibly a basis for the subsequent banknote regime with the state chartered banks? Obviously, two big debates during this period over the federal government's authority to charter a national bank. And after Jackson's vetoing of the rechartering of the second bank, there was no central bank per se in the United States between 1836 and 1913. And the United States is unique among 19th century industrializing national economies in this regard. But I think it's important to understand that a credit money system needs central banking services. And if the central government doesn't provide it, then there will be some other kind of institution that provides these kinds of services. And in the United States, I would argue it was during this period private bank, that is private bank clearinghouse associations, with the New York City Clearinghouse Association being the biggest and the dominant, and also the US Treasury itself provided central banking services. All right, so overall, I would say the economic historians would say that the American banking system performed pretty well. And here I would say Howard Bordenhorn's book, A History of Banking in Antebellum America, I think represents the consensus view pretty well. But the kind of metrics they're using are, growth in income per capita, right? So, which I think for this symposium, might be viewed as a somewhat limited metric, but this is the metric that's in that literature. So they would say that the growth in the bank supplied money and credit kept pace with the growth in the economy, supported economic growth, and that the banking system adapted to structural change in the economy that you saw, especially with the lowering of barriers to entry over the period. And I will say, especially after the demise of the second bank, there was increased access, the literature would say, to credit beyond the mercantile elite to include small traders, artisans, and farmers. But economic historians would remind us that, that state level efforts to restrict banks, which really came up, I would say, a lot in the 1840s after the very serious financial recession of 1839 to 1842, that those policies often had unintended consequences, and that there are real limits to the state's ability to control finance. Okay. But what is the economic, there's lots that economic historians haven't really helped us understand. So Bodenkorn says, the banking system was able to grow only because Americans were increasingly willing to accept and hold these banknotes instead of real things, right, that had value separately from their being money. But why did Americans trust these banknotes? Where does trust come from? And I would argue it is very much comes from political institutions, social networks. I think that other disciplines other than economics know more about these kinds of social formations. When Americans had the option of holding American coins, did they prefer the coins to the banknotes? That I think there's a lot more to understand there. And economic history tells us that policy mattered, therefore politics mattered, but really doesn't really tell us very much about why different states adopted different policies. And how did the heated politics of banking, those bank riots, are a very palpable form of that. How did the politics of banking affect banking policy? And finally, this is getting back to comments made earlier, is that in this period, there are very basic questions about money that were on the table and that I think are worth still debating today and are coming forward. So what extent should money be provided by the public sector as opposed to the private sector, especially today when we have really an expansion of the financial safety net? At every single banking or financial crisis, more and more of the financial system is brought under the safety net that ultimately is taxpayer financed. Who should pay for the money supply? Should the money supply be publicly subsidized? Or should it be set up in a way so that it basically pays for itself, either with seigniorage on minting the coin or with interest paid by borrowers? In a credit money system, the interest paid by borrowers basically pays for the monetary system. Does it really matter who pays? And finally, does the monetary system exclude members of society from the use of money or from the use of certain kinds of money, from the use of good money? And what are the implications of this for these members' quality of life and their ability to thrive? So I will close there and stop sharing and look forward to the discussion. Thank you very much.
Thank you so much, Jane. That's fantastic. So now we'll turn to Christine Desan, who has joined us. And Chris, if you want to unmute yourself and if you have want to share your screen and put up your material, that would be great.
I'm starting with a slide about our present, right? Our most recent past this spring. And this spending ball tracks the way money was spent during the COVID-19 crisis. The slide raises profound questions at the material level when we think about how capitalism channels money, and at the governance level when we think about who decided and how they decided to allocate basically $11 trillion. When we think about how people understood or experienced that decision, and what that decision even means in terms of our democracy, the way we conceptualize the public, the way we relate to each other. So let me talk just a few moments about the material issues that the slide raises, and then about, I would say, the governance issues. The material level. So consider the Fed, which dominates this slide. All the blue is the Fed spending. The Federal Reserve does not spend to small players. It supports commercial banks. It buys bonds from investors. It irrigates capital funding markets by supporting the financial deals of broker-dealers there. It supports corporate debt markets. When it stretches furthest, as in this crisis, it lends to large businesses. It made available some lending to state and municipalities on a very limited basis. The spending total by the Fed to those players was $7 to $9 trillion. That is 2 times the amount of the federal government's annual budget. Why does the Fed spend so much during the crisis? It's maintaining the infrastructure of capitalism. So capitalism is a system that operates by ceding money creation to private actors. That is, in a capitalist system, private actors make the blood supply. They make the medium of the economy, and they do that by allocating credit in money. That means we have private for-profit actors driving distribution from the ground up, right? From the moment we make the money supply. And those actors are on the front line for relief. They have to be on the front line for relief if they are the mechanism that produces the money supply. So notice that in this spring, we didn't have discussion about too big to fail. This is $7 trillion spent without the too big to fail discourse, because those, it wasn't a financial institution crisis. It was a crisis in the real economy. So to take the logic, the kind of observation that we're watching a rescue of the infrastructure, basically the monetary infrastructure of capitalism, to take that logic to Congress's spending, the rest of the spending on this slide, Congress works through commercial banks also, right? Congress's spending went through the same architecture, the same monetary hardwiring as did the Fed's, and that conditions its ability to spend. So Congress, first off, must borrow to spend. It creates a financial asset each time it borrows, a treasury bill or treasury bond. It pays interest on that debt. All of that adds to the national debt, pushes up against the debt limit. On substance, so that's just on process of congressional spending. If we look at how the money is actually spent, a big chunk of this congressional money actually is for the Fed. $454 billion goes to anchor Fed programs, $500 billion. Congress's direct lending program also goes through commercial banks. Given that route, the Paycheck Protection Program created by Congress doesn't reach many small businesses. As far as those businesses it does reach, the PPP was handicapped by conventional patterns of bank lending, including discriminatory under-inclusive reach to communities of color. Finally, even direct individual payments by Congress went through the financial system. So people were paid more effectively. This picks up on Jane's last point. If they had a bank account, if they had no bank account, they had more difficulty in getting payment. To top it off, those people who had difficulty getting payment had to use payday lenders in the interim. Just a comment on the material level that jumps out at us when we really think about the spending ball that represents COVID spending. To take an equally quick look at the governance level, the COVID-19 spending ball raises deeply disturbing questions at the constitutional level. When my constitutional law students looked at the ball and the patterns that it animates, that its spending animates, they saw one issue after another. And so also would the public see those issues. I'm going to put them in constitutional vocabulary just to capture them in a conventional way. So I admit it's disciplinarily parochial, but the issues, governance issues, include separation of powers questions. Why does the Fed have unlimited powers to spend to financial elites? Why does that lending flow more easily than spending by Congress? Why is Congress's spending hung up by traveling through the monetary hardwiring that the Fed is supporting? Separation of powers questions. Questions about the structure of Republican government. Where is the voice of those decimated by the crisis in this spending ball? Is this pattern part of a social compact, right? Have people consented to this structure of American governance and resource expenditure? Do people even know about this structure of American governance? So questions about Republican government. I used it in small r, right, early American sense. Questions about federalism. What path, if any, do the states have to influence this juggernaut? Where is the claim to those funds from the Fed for their economies, their poor communities, their essential workers? I would add, and my students did, due process and equal protection concerns. Are public authorities hiding behind the delegation to private entrepreneurs, the bankers and the investors, and therefore evading responsibility to create social welfare spending? Are we reinforcing race discriminatory structures through our monetary architecture? Are we establishing those structures, I would say, through our monetary architecture? Okay, so why is this a slide for a conference on early American money? The debates in early America over money created this slide. So those debates created the monetary hardwiring, the financial architecture we have. And I want to make just 3 points about that and why I attribute so much of the engineering here. Then I'll talk for a minute about why I attribute so much of the shape of our financial architecture, our monetary hardwiring, to the early American period. So first, just 3 points about what I mean by the monetary hardwiring. First, money, once we look at it closely, is an institution, a social, political, and legal institution. In society after society, it's a feat of collective engineering. That engineering turns on a unit of account, given political salience and material value by public authorities who act as stakeholders for their communities. That unit of account is then made viable as a circulating medium through an elaborate network that supports its transfer from hand to hand. Those qualities, the capacity of a unit to hold value, that is the definition of a unit of account, and the circulating character of the unit, are themselves established by reordering human relations in the community. So to be specific, we instill value in a token by rearranging political obligations, creating an asset that carries value as a political obligation in the eyes of public authorities, right? They'll take it for taxes, they'll enforce it. And we create transferability by using public authority to define commodities and their treatment. Commodities are, after all, things that can be negotiated for money. And that treatment of commodities is reinforced through a large apparatus, the law, as enforced by authorities. Those authorities do things like endorse the transfer of commodities for money, property, value their damage in money, tort, anticipate their future worth in money, all sorts of things that are important to finance. That is, authorities support exchange in money. They make the market by supporting money's transfer in particular ways. So once we open up money this way, is my point, once we ask how it's done, rather than simply assuming it as an abstract term or as an inert, sort of lump of value, or for that matter, an inarticulate convention, we find an enormously complex institution, a project, a political experiment, right, that a political community carries on over time. Second point here, that institution is a central or elemental terrain of governance of both material life and governance. So a few examples should suffice here. Money is the way that many, today, virtually all communities mobilize resources. It's the way they respond to pandemics, fight wars, organize the most basic systems of dispute resolution, create social welfare systems. We use money, right, to mobilize resources. Money is also the way that communities configure interpersonal relations. After all, when they enable a token to circulate, communities are creating and curating a market. So, given money's role as a medium, societies shape public and private life as they develop money. So societies are figuring out how to dispense money, how to diffuse credit in money, how to maintain the value of money, when to recalibrate the value of money. All these issues that Jane was just talking about when I came in, all of those acts shape public and private life profoundly. Third point here, right, second point, it's an elemental part of our material and life and governance. Third point about money, the institution that is money, that experiment has differed across communities and across time. I don't think I have to belabor this with this audience. So we can't understand a community that uses money without considering how creating that money entailed configuring its political system, dividing public and private roles in certain ways, defining the reach of money and claims made in money. Conversely, if we look at a community's medium and decode its design, we can understand an enormous amount about a society. So that brings me back to the spending ball. I would say that understanding this ball, or rather understanding the monetary hardwiring that produced it, is essential to understanding American society, how it organizes political power, how it organizes its markets, how people within its framework conceptualize both political power and markets. So then, how does the ball finally follow from early American monetary history? Why is early American monetary history essential to understanding the ball? I would say, in a nutshell, the Civil War is a pivot, an inflection point in the way Americans engineer money. It's a critically transformative moment in our monetary hardwiring, and I mean that literally. So American settlers conduct a debate about money from their earliest days as immigrants, colonists, and colonizers through the Civil War and Reconstruction period. I missed Jeff's statement, but he's of course the master in writing this history. This is his topic. So that debate is my point. My point is covers the period of this conference. In the Civil War, important matters are still unsettled. So I want to give just one illustrative example. In the Civil War, the US, the Union, makes money according to two totally different designs. One direct issue design, the greenback, and one bank design, the national banking system. These designs draw on different theories of political economy. So the greenback comes directly from legislative authority. It's issued as a kind of immediate IOU from the government through the figure of the Congress, without any relation to the financial architecture, banks, or investors. It locates profit from money making in the government. It distributed liquidity to a privileged group, the military, and suppliers to the military. That's the greenback. National banknotes, the national banking system, different theory of political economy. The national bank system delegated public authority to issue money to a network of private investors. They are going to be the ones who produce the money supply through national bank, their own promises to pay, national banknotes. It locates this system, this design, locates Congress as a body that had to borrow through the financial architecture in order to spend, right? So Congress, insofar as it coordinates its activity with the national banking system, will borrow from national banks and then spend national banknotes. It assigns profit from money making to private middlemen, the banks, and it determines that that group should distribute liquidity. So the privileged group is no longer the military. The privileged group is those to whom the banks will extend credit in money. Each design, the greenback and the banking system, drew on decades of American experience, experimentation, and debate. Greenbacks picked up on the colonial model of money creation that Jane mentioned. In that model, provincial legislatures had grown powerful by claiming power to create money. They monopolized agency over money. They controlled profits from money creation. Americans in that era understood money creation and taxation as intimately related elements of self-determination. Really interesting, again, this theory of political economy that they developed. The national banking system drew on profound changes that had occurred since the constitutional period. So Americans transformed national sovereignty at the constitutional moment. The Constitution assigned the federal government authority to define the national currency. It constricted state power. no longer allowing states to follow the colonial model of money making. In that moment, it channeled the imperative of economic development through banks at the federal level and at the state level. And here I'm picking up on a number of things that Jane said. It unleashed at the same time a whole series of debates about how we should understand contracts, corporations, capital markets, the place of investors, and their claims on the economy and on the polity, right? All of those ingredients are necessary to a banked monetary system. And the Supreme Court spends a lot of its time transforming doctrine on contracts, corporations, capital markets, the place of investors. The Civil War was the last time that the US would float those two different designs. The US went after the Civil War with the national banking system and develops that design. It's not that the experimentation is over, but the 20th century is a century of experimenting with banking, adding a central bank, playing with its powers, extending the system to include shadow banks, supporting the shadow banks, as the COVID ball shows. You get my point, right? If we are to understand where we are today, how we spent $11 trillion, why we spent it the way we did, who spent it, what it all means for our democracy and self-governance, we need to understand the early American debate and decision-making that created the Civil War experiment and the capitalist consequences that followed.
Fantastic. Well, thank you very much, all of you, for those very generative comments. And I'm going to jump right in with the question from the Q&A. And just a reminder that if you have any questions for the panelists, you can put them right in the Q&A right there at the bottom of your screen. So let's start with a question from Hannah Farber, and I'm going to read it out loud. So Hannah asks if the panelists could talk a little bit more about their approach to the definition of money. Antebellum people also circulated debts of other kinds in other ways, crummy shin plasters, personal IOUs, etc. And many different legalities applied to these. So she's asking, in your own work, how do you think about this in relationship to legal tender?
Shall I get us started? I mean, I think it's really clear legally that national currency is a debt of the sovereign that issues it. I was just going to look up the provision of the US Code. It's 12 USC 411, as I recall, right? There's another provision that makes that circulate. And that's not a formalism, right? The fact is that in every society I've looked at, the public demand for money is anchored by receivability, right? By the public's acceptance of its own debt. So that credit is at the root of money creation and of money as a unit of account. So and that's a really interesting governance project insofar as what the government's actually doing is converting obligations, making obligations to a government, political obligations, payable in a unit that it will recognize and take as set off against one's underlying obligations to a political community, right? Legal tender is also a very interesting attribute of that. It implicates the apparatus I spoke of to support the circulation of a money through its legal acceptance, which matters tremendously. And you can see today, in economic models today, you can actually break down the material value of both of these aspects of money's value. So you can separate the fiscal value of a token, its value for to pay off taxes, right? Its value as a proxy for some other material contribution that will satisfy the sovereign, and its value because it carries a premium as cash. So economists have quantified those things. I think each of those qualities that money exhibits, it's just the beginning of the story, right? About they can be different societies have supported those qualities in different ways, but they do seem chronic across different types of tokens. To get to Hannah's question about shin plasters, a collective can entail these qualities in tokens in interesting ways by reconfiguring legal and political obligations within the community. It doesn't have to be a state that does it. It can also be a community of a different type that can, within the bounds of its community, attribute value to a token and support its circulation. So part of what's fascinating about money to me is there are competitors. There are different groups that circulate money in different ways, or that create media that we could understand as monetary. And sometimes those debates, as in the case of the colonies, sometimes parochial or provincial efforts to compete with an existing money can actually produce a new state, right? Result in state building. Not so much in the 19th century, although, and maybe I shouldn't say that. I think actually a lot of the robust ascendance of state confidence and possibly secession itself in the Civil War was built on experimentation with money that ultimately threatened national union.
I'll jump in. I think that's a great question. And I guess I would answer it in the sense of we have lots of different money forms during this period, but there are different degrees of moneyness in these different forms of money. If you think of money as something that is, as economists would think of it, universally accepted, right? So a shin plaster that circulates within a local community, is supported by those social networks and business networks in that community, but probably wouldn't, circulate outside of that community. And so it would have less money than, I would say, specie during our period. But if I could jump in with just a question for Chris, about legal tender, because George Goldberg, I don't know if you're familiar with his work, has written about legal tender, and I just want to kind of understand the legal tender law during this period. Is this okay, Anne? I'm kind of deviating a bit. Okay. So he argues that with the legal tender law, you have something that has the status of legal tender. But if two parties enter into a contract, and one party says, you're going to pay me in something that's not legal tender, then he doesn't have to accept legal tender in payment. Is that true?
So I think it depends on the state law, right? So I think most states, today in most states, legal tender is the default, and you can contract around it, although there are limits on how much you can contract around it. So, one limit that springs to mind is, in early English common law, the writ of debt which you used to recover a debt could only be in coin. They wouldn't enforce it in anything else. So it's very much, it's one of the many interesting ways in which the courts, and that form of governance, are configuring what the possibilities are for exchange.
Right. So if the debt is not paid and it goes into a legal proceeding, then the legal tender can really rise to the fore.
Depending on how the state law is written, right? So the big legal tender cases after this that came out of the Civil War were about contracts in which it hadn't been specified how they were to be paid, and the question was, could the buyer pay in greenbacks, actually, and the court, and they're very dramatic cases. First, the court says no, and then the court says yes in a series of cases that today basically authorize our use of fiat money. They basically say, yes, you can use legal tender. And given that it was legal tender, the seller had to accept it as satisfying the debt.
Thank you.
So, Jeff, go ahead, please.
Yeah, I would just, I think I'm just echoing things that Chris and Jane said. That, I think one of the really interesting things about this period is that what counts as money is contested, that there are multiple monies. And as I mentioned, it seems to me it's a period when power lies in the ability to impose monetary obligations or dispose of them, and then to determine the means of discharging those debts. So when employers paid workers in scrip, they claimed a power that they were able, in a sense, to enforce, at least with their workers, to discharge a debt to their workers in scrip. When the U.S. paid annuities to Indian nations, in the 1830s, 40s, and 50s, it claimed a contested authority to determine the form of the annuity payments that would discharge those debts, and that there's a tremendous power in doing that. It's in a way that it seems like that's what's at stake in the Whiskey Rebellion, for example, when farmers who within their own communities are able to make and accept whiskey as a means of exchange, are confronted militarily with a government that says you can't discharge your debt of taxes in that means of payment. So I guess that's just a way of saying that the question Hannah is posing of what counts as money it's a fundamental question of power, and it seems to me that's what's really being fiercely contested in the early republic.
I think that was a great restatement of why the legal tender cases were so important. So just to connect what Jeff just said to what Jane and I were talking about, I mean, it was nation building literally after the Civil War, right? To assert that the federal government's IOU was legal tender and would satisfy obligations.
No, thank you. I should just say I'm so grateful for colleagues and attendees for putting questions into the Q&A. There are about 16 more conferences that we could have based on the rich suggestions that have come here, and I hope people will continue to put those questions up, and I can try to aggregate them and perhaps even share them with this wider audience once this conference or once today's event is over. But this is great. So what I want to do actually now is combine a couple of questions that have come from Renee Cordero, a graduate student in the Brown History Department, and Mark Peterson, professor at Yale University, about ways that we can connect the history of money to some of the present preoccupations of early American historians in a field that is increasingly concerned with settler colonialism and native dispossession, and the centrality of African slavery and anti-Black racism to the American experience. And as one way of sort of mainstreaming the history of money, it seems to me that the history of money has opportunities to help scholarship on these major issues. So I want to ask the panelists if they have any particular insights they want to share or potential directions for research to take that would make the history of money indispensable to our continued efforts to understand settler colonialism, African slavery, and anti-Black racism as constitutive elements of the early American experience.
One thing I've been thinking about is the relationship between the money question and Indian removal in the Jacksonian period. And because overwhelmingly the way that Indian land is dispossessed is through purchase, and the wholesale transfers of land in the 19th century overwhelmingly take the form of purchases, and often the purchases are over time. They're paid off over time with annual annuities. And often what's purchased then becomes transformed itself into a kind of land scrip under the Moral Land Act, or so-called half-breed scrip for mixed blood Indians of some groups. I do think debates about the form of payment are central to the conflict over Indian dispossession. Yeah, so that's one quick thought there.
So I would add to that by saying, I mean, I think the question really implicates definitions of capitalism, right? What we think capitalism is and how we approach it. And so answering from my angle, right, the way that I define capitalism is as a certain kind of monetary design, right? A monetary design in which a government delegates the power to create its medium to private investors. And I understand capitalism as the entire architecture that goes with that. So, you know, that form of banked money creation, that form of circulating bonds, capital markets that are built on that, commercial banking that's built on that. And if you think about capitalism that way, as opposed to in traditional Marxist ways, I think, then finance becomes the place to look for the definition of groups, including race discrimination and dispossession. So I think that from what we've talked about already, it's clear that finance becomes a method of defining community and of delineating powers and resources within the community. And I think if you look at finance that way, it's completely clear that the race kind of experience of Americans and racial dispossession is built into the project, the financial project, as it proceeds. So certainly what Jeff was talking about, the dispossession of Native Americans, and I'm thinking of both his work and Kay-Sue Park's work, is carried out monetarily in significant part. Then the commodification of Black Americans, I mean, it's an unbelievably dramatic example of the way that finance is defining and degrading human beings, right? Defining them as assets and then degrading them. In more modern history, we can trace the way the community is defined to exclude Black Americans. So there's more and more powerful histories now about the segregating effects of banking and the relegation of Black Americans to Black banks, which effectively disempowers them and diminishes their wealth. So I think, though I approach capitalism very differently from much of the current work that I think is, you know, locates labor at the heart of the definition, I locate finance at the heart, but that then gives us an instrument to see how finance is used to define communities and to exclude by race and to, you know, shape by race.
I'll just kind of briefly add that, you know, the whole aspect is, as Mark Peterson is pointing out in his question, the connection between money, finance, and land, I think runs through both the dispossession of Native Americans and the systematic impoverishment of Black Americans. As a lot of that story has to do with financing, purchasing, and development and redevelopment of land. And there's huge kind of like financial circuits that are created around real estate. And my colleague Carol Heim at University of Massachusetts Amherst is very interested in this aspect of capitalism, which I think is very interesting. But as someone said, and I don't know who, this country was built on land speculation. And land speculation has to be financed, right? Because the whole way that you create a vast amount of new value is through a some kind of credit-based financial banking system or financial system. And that goes right back, all the way back to the colonial period, where I would argue that the fiscal systems of those colonial governments obviously received huge infusions from the land that they took into their domain from Native Americans.
I could just add one other thing that occurs to me. It's an area that I think I have not thought through enough in my own work, but which is the relationship between debates about money and what's not paid for. Unpaid labor, for example, housework, slave labor. I think a fruitful direction, I think, for further thought and scholarship be thinking about how the definition and enforcement of new notions of money transforms what's not paid for as well as what is paid for. And that's a way I would amend in a set, or it's a more than an asterisk to something I had said in my opening comments about the problem, the question being who pays whom and how.
I'd also like to just jump in quickly and add one other way where I think we see money intersecting both with racialized forms of labor and dispossession. And that's just to point out that the best form of money in the early republic is still specie, gold and silver coins. And I think that brings us into this in a slightly different way because those are commodities that need to be produced. And if we look at the actual origins of gold and silver that circulated in the period, all of it comes from land that has been dispossessed from Native people, whether in the Americas or elsewhere, and it is usually created by enslaved laborers of various kinds, whether they be enslaved Native people, African descended people, or even Chinese labor, for example, during the California Gold Rush. So I do think we can also see that there are some very material links between the way money works and where it comes from, and these forms of dispossession and enslavement in the period. So I'd also like to ask another combination question. So we have a few people, Dale Norwood and Hal Cook, who've asked us to kind of think beyond the framework of just the nation, which I think we've mostly been talking about in this. And they're wondering how putting money in an international perspective, both realizing that the US exists within a global marketplace, and also that Americans are very often using foreign money, can change the way that we understand or think about money in this particular period.
I'm kind of tempted to look up, I have somewhere on my computer a map that shows central banking going viral across the globe. So, I mean, I do think that there's a story of empire that is closely connected with the spread of different forms of finance. And in particular, I mean, I'm interested in capitalism's architecture as a financial matter. And you can see that going viral during the 19th century. And they're very interesting debates and connections, you know, many things to pull out there as we see those relations spread across the globe and create different kinds of contests, different kinds of resistance, different kinds of accommodation, different kinds of extraction. Right?
One thing it calls to mind for me, of course, in the postbellum period, international norms of money becomes really central with it, questions around the international gold standard. But in the antebellum era, also one area of current research, I think, on history of money has to do with the history of mining, assaying, refining, and minting, and that's clearly a transnational story. And I know Manuel Bautista Gonzalez and Rick Elliott and a few other scholars are working on that.
Yeah, I would like to, very good, great question. I want to bring it back to the diagram that Chris put up at the beginning of her presentation, showing the enormous infusion of liquidity through Federal Reserve lending. And one reason why the US Federal Reserve was able to do that is that the US dollar is a global world currency. And is accepted globally, and other countries that whose currencies do not have that status were not able to respond in the same way that the U.S. central bank was able to respond. So in the antebellum period, the money that was issued by whoever, whether the federal government or state banks in the United States, did not have that status internationally. But of course, over time, the U.S. money attained that status. And there's economic history literatures around this reserve, who gets reserve currency status? Why does it change over time? And then during our period, though, much of our reserve, what the basis of the banking system, the specie, did come from outside the United States, at least for a good portion of this period. And so it was really the money that came out of the mints that Anna was talking about that had the status of global money in our period.
Can I just add one thing that Jane and Jeff made me think about? I mean, at the conceptual level, the gold standard, and I'm drawing on the sort of Jane's point about contests over universality of money, that the debates around the gold standard produce a different way of thinking about money, produce an emphatic naturalization of money, and become part of money's neutralization, I would say, as a disciplinary matter in economics. So the sort of amount of effort that is put into the amount of rhetoric calculated to secure the legitimacy of the banking system is closely, is the gold standard project I think, and that is effectively, conducted at the international level, and the international becomes a kind of symbol of the fact that money ideally wasn't domestic, right? It wasn't about domestic politics, it was about international trade, right? So in odd ways, I think the international becomes extremely important to the way we conceive money as outside of politics, as ideally about trade, as sort of naturally driven by exchange. I think that's really a function of the gold standard and the practice and ideology around the gold standard.
No, thank you for that. I want to ask a question actually about disciplinarity, because one of the remarkable things about our conversation today, but also about the larger history of money conversation that's been emerging in the scholarship, is that it's drawing from scholars in lots of different places located across divisions, departments, and programs and schools within the university itself. But oftentimes when we talk about interdisciplinarity, right, we talk about some of the translation problems, some of the sort of disparities of expertise. And so I guess what I would want to ask is, from your three respective disciplinary positions, are there certain things that you wish other participants in this discussion had at their disposal, conversations that they knew more about, or theories or concepts they were more conversant in, or things that they were attuned to, they would benefit from reading or knowing about, that would help get us all perhaps closer to being on the same page as we work through this history?
It's a great question, and I don't think I'm directly answering it here by saying what I wish other people knew more about. What I found in studying early American money was that the divisions that we make between what's kind of an economic or political and economic question and what's a sociological or anthropological or literary or psychological or scientific question, those distinctions were not part of early American discourse about money. And early American discourse, the debates about money were so deeply bound up with understandings of value across what we would call many disciplines: art, architecture, literature, science, law, agriculture, that I think that's in some ways a challenge in studying the period. And the converse is the way in which since then, really in the late 19th and early 20th century, economics became separated into not just a special field of expertise, but a highly technical field of expertise. that makes the money question less accessible, that makes it seem more esoteric, that makes it, that's it, one of the things that brought me into studying the money question was a problem I had in teaching, which is that it was hard to assign my students even very popular work like Cohen's Financial School or William Gouge's Short History of the Banking Question. In America, even to assign 10 pages of that without students finding it very hard to access. I mean, these are things that were written not for people in college, but for people with a little or no education. So that's a translation problem that I felt I had as a scholar of early America.
So I guess I would pick up on that by saying, you know, the first like 5 years I was looking at colonial legislative activity, I skipped the money issues every time I got to them because they're too hard to figure out, right? And I didn't, and I think Jeff's entirely right, sort of playing in my mind is this is something for the economists or for the economic historians. And then at some point I realized that they were really at the center of what the governance debate was about. They were really at the center of things, and that so this is kind of a pitch and a plea to people. I think it's incredibly difficult to figure out oftentimes just the mundane mechanics of something. So, you know, for 10 years, I've been knocking my head against the wall about, you know, sort of the debates of different accounts of the way banks work and how they multiply the money supply. And then trying to understand, you know, trying to be able to pin things down in terms that at least understand the discrepancy between the way different disciplines quantify or try to capture material value. Anyway, the pitch, I don't want to get I want to acknowledge that it's very difficult, that there's a lot of really difficult mechanics, and I think the invitation, the thing that makes that worth it is that they're enormously important, both to what's going on in daily life today, as well as, you know, 1830. They're enormously important. They take up a great amount of people's everyday life and affect their material well-being. And they're also conceptually extremely important, both in ways that Jeff was just talking about at the moment, but they're also conceptually important because they explain a lot about our disciplinary divisions today. So I think, you know, many of the ways that I understand money, you know, I've worked out banging my head against and in dialogue with economic models, but also disagreeing with it, you know, and being able to pinpoint my areas of disagreement with economists. That's all been very important and generative. So I think it's, you know, the pitch is that it's worth it, but I think it's a real obstacle. It's a hard thing.
I guess I might turn this question around a little bit. I mean, I think that when I look at the direction that economic history is moving, it's moving in a very quantitative direction where, you know, very use of, you know, very sophisticated time series, econometric estimations, and it looks a lot to me like just macroeconomic theory, honestly. And so I think in many respects, the economic history is maybe moving in a direction that is less useful for really understanding money. And that, you know, what I think we're doing here is for me right now, I think a little much more useful. I'm going to just I think what Chris said about understanding the mechanics of money is there's a lot of opportunity there, especially with using archival work to understand, you know, how did these transactions really work? You know, how were these networks formed? Who were in the networks? You know, what is a bill of exchange? You know, who used the bills of exchange? Who didn't? And what is this instrument? These are things that theory can't really tell us, right? It's really, and what was, you know, in daily life, you know, how did money work? I think that there's a lot to be learned from just, you know, primary evidence that we get from various directions. I also think that for me, it's all, you know, it's balance sheets, right? It's like if you can kind of draw it on a balance sheet, you know, then you're kind of well on your way to understanding how money works.
Great. So I think we have time for one last question. So I'm going to try to put together a couple different questions that we've gotten that are about how we as historians should be talking about modern day political debates over money. And so we've had a few people who point out that studying money in the early American Republic means studying debates over how money should be organized, and in particular, who it should benefit. And we're starting to see this again, especially in debates over financing the Green New Deal or Medicare for All. And so I'd like to hear from all of you, what kind of insights do you think that this period has for our modern period? And also, what do you think our responsibility as historians should be to participate in these debates?
I'm going to jump in with something that came to mind during Chris's presentation, I think touches on this great question here, which is in that diagram that we saw, well over half of all of the stimulus that was provided through the Fed into commercial banks versus directly through the congressional appropriations, right? And when all that was happening during the pandemic, so when all that was happening, I was thinking that, okay, the president's talking about, getting a check to every household. I'm thinking, but he can't do it. The US Treasury does not have the infrastructure to get a check, to get money to every individual household in the United States. The banking system can't either, but it can reach a lot more people. And isn't that interesting? And you think about how long it took for states to get their unemployment insurance compensation checks out. That's all the state level. We've chosen to give that all over to the states, right? So there's something about, the way our fiscal and monetary, because these are fiscal systems are always, and monetary systems to me are always two sides of the picture that you need to really look at both. So we've set up a fiscal monetary infrastructure that turned out to be not that helpful in the crisis that we're still in today.
I would just pick up on that. It seems to me that early Americans raised questions that are profound questions about money, that more profound than the answers that were on offer for them at the time, and more profound even than the ways in which they approached them. For example, a question about banks' control of the money supply, seeing that as a political question, a constitutional question, a question about democracy. That seems to me like a profound insight, even though the approach to the question, for example, a focus on no issue, was limited by its historical circumstances. So I feel like we can retrieve questions that early Americans posed, but because they didn't take for granted, for example, as Chris said, they didn't take for granted that money comes from banks. That's it does seem to me that nowadays criticisms of banking tend to stop short of questioning banks' control to begin with of the money supply. But the rise of various kinds of alternative currencies in recent years, I think, have maybe opened up those questions anew. But still, I'd say it's the case that political questions about where money goes, like the spending ball that Chris put up, tend to be debated as fiscal problems, not as monetary problems. And that the fact that early Americans saw those as intertwined is, I think that's a rich set of insights and questions to retrieve from early America.
So I would just add to that, I agree completely with what both Jane and Jeff said. And picking up on Jeff's last point, I do think the debates, so, you know, so the whole pitch I made was that the architecture of that spending ball does have its roots in early American monetary history. And I think that kind of gives us our marching orders. But the debates, as Jeff was stressing, are also really revealing, and they sort of shake our assumptions and the conventions that the sociology of knowledge that we've assimilated as modern Americans. And I would just add to that by saying the debates are, the aspect, you know, the centrality of packaging value and moving it about is really significant, so that it's not just, it's not a discrete issue, you know, there's this kind of money and it means this. If you have this kind of money, it affects all sorts of other aspects of the way we think. So, you know, really the work, you can see contract being transformed. This is Roy Kreitner's work, right, in the 19th century. You can see corporations being redefined during the 19th century in ways that are very, you know, that dovetail with or are meant in some way to interact with the changing monetary system. And when you add up all these other aspects of human life that are interdependent with the way that we, or are part of the way we package value, you're really talking about, you know, human agency itself. I mean, really conceptions of how we live and conceptions of politics. So I think the stakes are high, and they're worth putting our efforts and passion into. The other thing I would just say is, what about responsibility? So I guess partly I've answered that implicitly, but I do think I have thought about this a lot, because part of our role is to educate, right? We're scholars and teachers, and we chose those fields for very specific reasons. But I also have found that that there are public regarding activities that have, for me, become part of that, and that may naturally fit, or with effort fit, into our role. So the debates today about public banking, about Fed accounts, you know, direct accounts at the Fed. There are a lot of debates today. In some ways, the crisis in capitalism opens the door to debates that we can illuminate, or that we should try to illuminate. So, for example, there's an effort to think about to get a public bank in Massachusetts right now, in which I'm involved, because it seemed that the work I was doing could help inform that debate. So I think there are opportunities there as well, in more direct public reform efforts, although it's really hard to juggle with just the regular teaching and scholarship.
All right, well, I think that's a great note to end on. So I'd like to thank all of our panelists for such a great roundtable and a really robust discussion. I know I learned a lot. I hope everybody watching did too. And I'd also like to thank the Watson Institute and the Rhodes Center for hosting this, and for all of you for taking time out on your Thursday to come talk about early American money for a few hours. So thank you very much. I really appreciate it. And I hope these conversations continue.